The Intelligent Investor. Benjamin Graham's The Intelligent Investor is considered the Bible of investing. Starting with the terms used in the investment industry and ending with the magnitude of investment choices. Everything has been presented in a very thorough and nuanced way. Please continue reading if you have ever wished to become a successful investor. Benjamin Graham was a professional investor and economist from the United States. It is believed that Graham was the first person to advocate value investing. Warren Buffett called Graham the second most significant person in his life behind his father, and he attributes this to the fact that he gave him a solid foundation in intellectual investing. The astute investor helps the readers develop the right mental and emotional attitudes toward their financial decisions by providing reasons, examples, and useful ideas. It will demonstrate that a lay investor may produce a respectable outcome with little skill and effort. This book's goal is to provide layperson-friendly guidelines for adopting and implementing an effective investing strategy. Speculators, or those who trade in the market on a regular basis, are not the target audience for this book, which also does not attempt to teach you how to beat the market. Section 1. Who qualifies as an astute investor? First, let's address the most crucial query. Why invest? Due to inflation, it depletes our wealth by around 3% a year and is quite simple to ignore. The cost of living is increasing practically every year, which will hurt those on a fixed dollar income. However, owners of good assets may be able to offset a decline in the dollar's buying power with increases in dividend payments and the value of their investment portfolio. What does Graham mean by intelligent investor? Then, it only entails having patience, self-control, and a desire to learn. You also need to control your emotions and exercise independent judgment. Your assets will eventually lose value, no matter how cautious you are. Regretfully, you can only manage that danger and moderate your worries. You cannot completely eradicate it. To put it another way, an investor's biggest issue and toughest adversary will probably be themselves. For this reason, Graham always highlights 3 points. How to reduce the likelihood of incurring permanent losses. How to increase your chances of making long-term gains. How to stop the self-defeating actions that prevent the majority of investors from realizing their full potential. The first thing savvy investors need to understand is that equities get riskier as their prices increase, not less, and less risky as they decline. When a bull market rises, the astute investor fears it because it increases the cost of purchasing equities. On the other hand, when the market declines, you should rejoice since it means that stocks are once again available for purchase. By not overpaying for an investment, you reduce the likelihood that your money would ever vanish or be abruptly destroyed, which is made easier by Graham's margin of safety theory. It's also crucial to note that Graham refers to investors rather than speculators. Speculators make money for their brokers, while investors make money for themselves. An investing activity is one that, after careful examination, guarantees both a sufficient return and the protection of principal. Activities that don't fit these criteria are speculative. We will examine 2 categories of investors in the remainder of this synopsis. The defensive or passive investor aspires to be free from effort, irritation, and the necessity to make judgments often in order to prevent serious errors or losses. Expecting a higher average return than the passive investor, the entrepreneurial or active or aggressive investor is prepared to invest time and effort in choosing assets that are both solid and more appealing than the norm. Acquiring a diverse portfolio of top common stocks and high-grade bonds, which any investor can do with little to no help from a specialist. Section 2. The protective investor. A defensive investor sits still and wins the race. If the stock market has increased, don't purchase more. If it has decreased, don't sell. Graham's strategy is based on replacing conjecture with discipline. In this case, a 50% bonds to 50% common stock ratio makes sense. Any variance is contingent upon your outlook, level of risk tolerance, and personal circumstances. Invest at least 25% of your money in bonds or cash if you can afford to take on more risk. Aim for no more than 75% in bonds or cash if you're a risk-apprehensive person. Only alter these percentages in response to changes in your personal situation. Every 6 months, on memorable days, like New Year's and July 4th, rebalance. Bonds. Bonds protect and stabilize your portfolio while providing lower returns. Therefore, it is better to avoid high-yield, low-quality bonds. U.S. savings bonds, Series E and H, are the main bond kind that investors should take into account. Along with the ease of monthly income that you may put directly back into the fund at current rates without incurring a charge, bond funds provide inexpensive and simple diversification. Bond funds are far superior to individual bonds for the majority of investors. Typical stocks, because they provide a significant level of inflation protection and greater average returns over time, you can only afford to include a sizable percentage of high-quality common stocks in your portfolio. Graham's guidelines for the component of common stock. A minimum of 10 distinct topics and a maximum of 30 issues indicate adequate but not excessive variety. Limit your investments to the stock of significant businesses that have a track record of successful operations, sound financial standing, and consistent dividend payments. Set your price limit for an issue at 25 times its average profits over the previous 7 years, but no more than 20 times its earnings from the previous year. Such a technique removes the whole category of growth stocks, as well as the most well-known and robust corporations. A brief explanation of rule number 3 is that if you pay a high price for your shares, you may lose the benefits in your portfolio. Large, moderately unpopular businesses, on the other hand, are a wise choice since they may be located at fair earnings multipliers. But only after evaluating a company's financial records and determining its business worth should you make an investment. The best approach for a defensive investor to benefit from stock ownership without having to worry about portfolio management is through mutual funds. You may purchase a high level of convenience and diversification for a comparatively little price. You are entrusting the stock selection and monitoring to an expert. Regardless of whether the markets have increased or decreased, you purchase more every week, month, or quarter. Index funds. However, holding a portfolio of index funds is the best course of action. Index funds possess all the valuable stocks and bonds. In this manner, you give up speculating about the direction of the market. You can realistically spare $500 per month. You can guarantee that you own practically every investment worth holding in the world by owning only 3 index funds: $300 in one that holds the whole U.S. stock market, $100 in one that contains overseas equities, and $100 in one that holds U.S. bonds. Like clockwork, you purchase more each month. Your predetermined sum travels farther and buys you more shares than it did the previous month if the market has declined. Your money will purchase fewer shares as the market rises. You may avoid throwing money at the rising market, which is riskier since it is more costly to acquire, or refusing to take more after a market fall has made assets really cheaper, but ostensibly more risky. By keeping your portfolio on perpetual autopilot, you should anticipate a 6.7% annual return if you expect an index fund portfolio to perform with an average overall return of 7%. This will cost around 0.3% of the portfolio's value. There is no better instrument for low-maintenance stock investing than a low-cost index fund, and any attempt to improve upon it requires more work and therefore greater risk and expenses than a really defensive investor can justify. You will almost certainly exceed the great majority of both professional and individual investors if you hold an index fund for 20 years or longer and add additional money each month. Buffett and Graham both commended index funds. Even during the worst bear market in history and the Great Depression, that is the power of disciplined buying. The intellectual difficulty and distraction of selecting particular equities appeals to some defensive investors. Then, leave 10% of your stock money to try your hand at stock selection, and keep the remaining 90% in an index fund. Never mix the funds in your investment accounts with those in your speculative account, nor let your speculative thoughts influence your investing activity. Section 3. The enterprising trader. The aggressive investor will begin with the same foundation as the defensive investor, but if sophisticated research shows that other assets are appealing, they will also go out. You could discover that, rather from achieving somewhat better than anticipated returns, you've done substantially worse if you add a bit more expertise and cunning to your investing program. For aggressive investors, Graham outlines his don'ts. Bonds with a high yield. Foreign bonds, if you can tolerate a lot of risk, can be attractive. The adage, the more you trade, the less you keep, applies to day trading, which involves owning stocks for a few hours. selling in high markets and low markets. If you pay too much for the stock, a great company is not a great investment. Well-selected growth stocks. Invest in growth stocks when something goes wrong, not when they are at their peak popularity. Various deal issues. You can purchase a great company at a reasonable price by experiencing temporary unpopularity, which creates lasting wealth. However, it's worth reiterating that picking specific equities is superfluous, if not unwise, even for aggressive investors. Only a tiny portion of investors are skilled stock pickers. It would be preferable for everyone else to obtain assistance, preferably in the form of an index fund. Graham suggested that investors practice first if they were adamant. Begin by tracking and selecting stocks for a year, without using actual money. Test driving your methods before attempting them with real money allows you to understand what works for you, make mistakes without suffering real losses, and cultivate the self-control to refrain from trading frequently. If you didn't like the experiment or your options weren't good, it didn't hurt you. Invest in an index fund instead of wasting time choosing stocks. Assemble a basket of stocks progressively, but keep it at no more than 10% of your total portfolio. Keep the remainder in an index fund if you found the experiment enjoyable and the results were good enough. Additionally, if you lose interest in it or your returns start to decline, quit. One more piece of advice on aggressive investing. In the end, financial risk stems from your investing style rather than the kind of things you own. You are at risk. Go to the closest restroom and approach the mirror to find out what risk is. Looking back at you through the glass is dangerous. Risk management, not risk avoidance, is the key to successful investment. Important takeaways. Because inflation reduces our wealth, we invest. An astute investor controls their emotions, manages risk and anxiety, and is patient, disciplined, and willing to learn. As stock prices increase, they become riskier, and when they fall, they become less risky. Refusing to overpay for an investment reduces the likelihood that you will lose your riches. For a defensive investor, it makes sense to invest 50% in bonds and 50% in common stocks. You will outperform the great majority if you hold an index fund for 20 years or more and add additional money every month. The book review of The Intelligent Investor. Benjamin Graham's classic work on investing, The Intelligent Investor, provides priceless insights into the world of investing. When making financial selections, Graham stresses the value of thorough research, a long-term outlook, and a margin of safety. In addition to offering helpful guidance on risk avoidance and portfolio management, he presents ideas such as value investing. Written in an easy-to-read language, this book gives readers the skills and information they need to deal with the stock market's volatility. The Intelligent Investor is a must-read book for both new and seasoned investors due to its focus on discipline and reason. Thank you.